On average, CEO pay increases more than 5% each year. While it declined during the 2008 financial crisis, it bounced back in 2010 by an increase of 35% on average among firms in the S&P 500. Compare that to annual salary increases for employees, which are definitely not that high. Since there's still a lot of information to sort through, and I'm still looking into these two Florida companies, I thought I'd start by taking one big company and looking at historical years of executive compensation to see how it's changed with insurance, sort of a baseline, if you will. The obvious one to look at, of course, is AIG. Welcome back to the Insurance versus History podcast. I'm Meredith Brasher, writer, host, historian, and former insurance underwriter. If you're a curious person and you want to understand what insurance is, what it does, why it matters, and how an industry so large could have such a low profile, you're in the right place. Today I'm going to talk about what has become a bit of a project for me: executive compensation in the insurance industry. I'm going to call this episode part one of probably 2, maybe 3 episodes, depending on how much I'm able to find and process about this topic. I started researching thinking this would take a few days, and well, it's a project that's probably going to take a few months. But I also need your help to complete it, so I thought I'd talk a bit about it today and what I know so far. We're coming up on end-of-year reviews for everyone, and insurance executive compensation, especially in Florida, has been in the news lately, so it seemed like the right time to at least get started talking about this. Before I get started, I have a couple of shout-outs. If you follow me on LinkedIn, and you should, you probably will have seen I recently did an interview with Laura Witcher, who has a blog on LinkedIn about women in insurance called, not surprisingly, Women in Insurance. You can check the blog out online at the Women in Insurance page on LinkedIn and connect with her if you're interested in what she has to say. I also spoke earlier this year with John Weber at AM Best, and that video interview was published in early November on the AM Best website. We talked about the Insurance versus History podcast and how it started, and how it's going. There is also an article about the podcast in the November issue of AM Best magazine, so you can check that out too. Other than that, you know the drill. Rate and review, subscribe, connect with me on LinkedIn, send me an email. Hire me to come talk to your group. Send me money for production costs on Buy Me a Coffee. Links are all in the show notes. I have an updated website too at insurancevshistory.com, which you can check out. You can leave comments, and you can even leave me a voicemail. You may have also noticed something new on the podcast: ads. I don't have control over the ad content, and the ads you hear are different for different people. I was hesitant to allow ads on the podcast, and I'm still kind of ambivalent. And if you hear any ads that are problematic or you find controversial, please let me know so I can take it up with my podcast service. Oh, and one more thing. I thought for December it would be fun to do a holiday-themed episode. And, well, by holiday-themed, I mean, Festivus. The Festivus for the rest of us, which features the famous airing of grievances from Seinfeld. Do you have grievances about the industry? I know you do. Share them with me and be featured on the podcast. Or you can be anonymous too, no problem. You can send them to me via LinkedIn or email me directly. I cannot wait to hear them. That was a lot of stuff, and thanks for sticking around. Let's get into the story. A few months ago, there was an article in Insurance Journal that got picked up by a few other news organizations about executive pay in insurance, specifically highlighting the pay packages of a couple of CEOs, the head of a company called Slide Insurance in Florida, and another Florida carrier called HCI, and the head of Arch Insurance, which, full disclosure, is a former employer of mine. Now, first of all, anyone writing Florida property coverage right now and making a profit deserves scrutiny anyway, but Florida property companies with CEO compensation that's in the same range as, Evan Greenberg at Chubb or Peter Zaffino from AIG, well, that should make most of us very curious. Slide Insurance writes homeowners coverage in 2 states, Florida and South Carolina. They are gearing up for an IPO. And in the SEC documentation apparently revealed that the CEO received $21 million in, quote, salary bonuses and stock awards, unquote, which to me seems like a lot. The other Florida CEO mentioned in the article is the CEO of a company called HCI Group, which does a bunch of stuff, mostly, again, homeowners coverage in Florida, but they also have an insurtech operation. Now, that CEO brings home $20.2 million a year, although I don't know what they received in 2024. The 2025 pay package apparently involves bonuses based on share price targets and other things, so it is entirely possible they won't see that entire $20.2 million. This is the same argument online about Elon Musk's recently approved $1 trillion pay package, that it's not a true number, it's just a best-case scenario. Now compare this to the 2024 pay packages of Evan Greenberg at Chubb, who brought home approximately $27.6 million, and AIG's Zaffino, who made about $24.6 million. I'm going to break this down further, but that's the basics of what we're talking about. I started to do some research and I thought, hey, let's just put together a quick spreadsheet and see what we see in terms of how insurance CEOs are compensated. And what I found, well, it's taking a while. It's become a project that's probably going to take some time. Today, though, I want to talk a bit about the history of executive compensation in the insurance industry and what I'm hoping to do with this project overall. And then I'm going to ask for your help. My first question from a historical standpoint was, what could I find out about executive compensation over time in the insurance industry? There are a couple of resources. However, this search suffers from the same problem that a general search of this information, of the history of executive compensation in American publicly owned companies, period, which is that the data doesn't go back as far as I would like. We actually don't have a lot of academic data about executive compensation until about the late 1930s, although it will reassure you, well, maybe, that Americans had been complaining about executive pay all through the 1920s and, of course, after the Great Depression hit. In fact, in the New York Times, they published lists showing companies and their executives and what they made, which I must say is very fun to look through. The term CEO doesn't really come into common usage until the 1970s, but for the purposes of this project, I'm going to use it to refer to the past as well, though in the past, in those earlier years, the heads of companies might be called chairmen or presidents instead, but they're basically the same thing for our purposes. We're talking about the person at the top of the company, so to speak. There was no requirement that CEO pay be disclosed to anyone outside the company until 1933, when the U.S. government, specifically the Federal Trade Commission, started asking every company listed on the New York Stock Exchange to provide that information. You would think then that there would be a database somewhere you could search through, but alas. The FTC was formed in 1914, and the Securities Act of 1933 was the document that required, among other things, this pay disclosure. The SEC was created in 1934 to take on the tasks of the 1933 Securities Act. The problem is that there weren't any insurance companies on the New York Stock Exchange until decades later, so that doesn't really help us. But just to talk about what was revealed by the early years of executive compensation, you can see that, for example, the largest companies in the U.S. in 1929 included U.S. Steel, with revenues of $1.2 billion. They were the first billion-dollar company in the United States, by the way. And then another company we can use as an example is General Motors, and they had revenues of $173 million. This information comes from the New York Times, who was publishing lists of executive compensation in the 1920s. If you took this revenue number and you translated it to 2025 numbers using an inflation calculator, you would get approximately $22 billion in revenue for U.S. Steel and $4 billion in revenue for General Motors. And yes, there is a big disparity here. U.S. Steel was the biggest company in the U.S. in the 1920s by a mile. What did those top executives make? For U.S. Steel, we know that in 1933, the chairman was Myron Taylor, and he brought home about $162,000. Adjusted for inflation to 2025, that's about $3.9 million on a revenue of about $22 billion. The chairman of General Motors made a lot more than that, so much more so that it actually made the papers for a while. Alfred P. Sloan had a salary of $120,000 and a bonus of $387,450 in 1936. So that's a total of, say, $11 million or so adjusted for 2025 on a revenue of $4 billion. I had to go back and double check if Myron Taylor of U.S. Steel also got a nice bonus. And it looked like he did, but the New York Times reported it as about $4,000. So it's a little bit off from that, $387,000. Immediately I noticed, and you probably did too, and this is one thing that I'm starting to find as I'm researching executive compensation for the last 40 years, it's all over the place. So how does a person running a company that is 5 times bigger, U.S. Steel, make less than half of someone running a company that is so much smaller, General Motors? This is a mystery, and I'm hoping to figure it out. From an insurance standpoint, we really can't go back that far, but we do know something about a handful of life insurance executives in the early years of the 20th century. And then there's a big information gap until we get to about the 1960s or so. I'm going to talk about the Equitable again, because when I thought about who I could look at in comparison, the most obvious first person is, of course, Henry Baldwin Hyde. And that's not just because I'm a little bit obsessed with the Equitable and I want to write a book about it, but because he was actually one of the first modern insurance industry leaders, and the Equitable was one of the very first large insurance companies in the U.S. Just to give you a quick rundown, if you don't know who he is, Henry Baldwin Hyde was the head of the Equitable Life Assurance with an A, Company of the United States. That is not to be confused with the 7 million other insurance companies named Equitable in the U.S. This was a life insurance company based in New York, and they were established before the Civil War. By the early 20th century, the Equitable had assets over $1 billion, making it the largest insurance company in the world. Henry Baldwin Hyde's salary was somewhere in the $100,000 range, and adjusted for inflation, that would put him at about $3.6 million today. And since we're talking about the early 20th century, for Henry Baldwin Hyde, he stopped working at the Equitable about 1905 or so. But if you look at the New York Times listing of executive compensation in the early 1930s, it's not that far off. There are lots of company leaders making about $100,000 or so in 1930s dollars, which again puts them in the $3 million range, adjusted for inflation. What's fascinating to me about this is that there are actually a lot of CEOs of insurance companies today making about that same $3 million range. But there are also a lot of CEOs making a whole lot more. I have to jump to the 1970s to get good information on insurance CEO salaries, but there were a couple of things that happened between the 30s and the 70s that I think need to be said. First, when we look at those 1930 salaries, we see the actual salary and bonus numbers. What we don't see is something that most CEOs get these days, which are stock or stock options. While some CEOs probably got some kind of stock in their salary package, this did not become common until the 1950s. And that's because the U.S. government changed the tax law to allow something called restricted stock options to be taxed differently than income. These restricted stock options are usually tied to some kind of performance metric. So hitting a certain revenue or a stock price target, and then staying at the company for some specific length of time. Before those conditions are met, you really can't do anything with the stock options, so they'd argue, and Elon Musk is currently arguing, that those stock options are not really worth anything right now. I'm not sure I'd agree. According to research at the Yale School of Management, in 1950, only about 16% of CEOs or their equivalent title had stock options as part of their compensation. By the 1990s, over 80% of CEOs had this. What I'd like to know is how often they met those supposed targets and were able to claim those stock options, and I don't have that information yet. There has to be a very good reason why stock options became so popular, and I'm guessing it's partly because they were very often able to access them by meeting those targets. Second, it appears that overall CEO pay stayed consistent with inflation until the 1970s, meaning that what they got paid in the 1930s and 1940s was not so different, once you adjust for inflation, than what they got paid in the 1950s and 1960s. In the 1970s, that's when we start to see the significant increase in salaries and compensation packages. And here's a number you can try to take with you in your performance review. On average, CEO pay increases more than 5% each year. While it declined during the 2008 financial crisis, it bounced back in 2010 by an increase of 35% on average among firms in the S&P 500. Compare that to annual salary increases for employees, which are definitely not that high. Since there's still a lot of information to sort through, and I'm still looking into these two Florida companies, I thought I'd start by taking one big company and looking at historical years of executive compensation to see how it's changed with insurance, sort of a baseline, if you will. The obvious one to look at, of course, is AIG. AIG was the first insurance company listed on the New York Stock Exchange in 1973, and many of you probably already know the history of AIG, but if not, or you need a reminder, here's the basics. Cornelius Vanderstar was the first CEO of what could officially be called AIG, and he held that position until 1968. Maurice Greenberg, aka Hank, was the CEO from 1968 until about 2005, when he resigned, very unhappily, I might add, in the wake of Elliot Spitzer's various investigations into the industry and especially into AIG. Hank was replaced by Martin J. Sullivan from 2005 to 2008, which of course is when the 2008 financial disaster happened, of which AIG was intimately involved. There were two CEOs in 2008, at which point Robert Benmosh was CEO from 2009 to 2014. Peter Hancock was CEO from 2014 to 2017, and then Brian Duperreault was CEO from 2017 to 2021, and Peter Zaffino has been CEO since 2021. The information I'm about to share is all publicly available information I pulled from the SEC filings for AIG, which we can access easily until about 1993. Earlier than that, it gets complicated, and I don't have that information yet, but I'm hoping to have it in hand fairly soon. I'm going to skip over Cornelius Vanderstar, and I'm going to go right into Hank Greenberg a la 1993. Salary-wise, Greenberg pretty much took about $1 million in actual salary in most years. His total compensation, including stocks and bonus, was about $5 million in the 1990s. Not too bad for him. 10 years later, in 2003, Hank is earning a little over $8 million. When he resigns from the CEO role, which, by the way, if you want more information on that, you can see my Elliot Spitzer episode. When he resigned, they paid him $19 million. That was a good deal for him, but I was actually surprised it was so low, given his long tenure and how PO'd he was about resigning. Though I'm pretty sure he always intended to just lay low for a year or two and then come back as CEO. Unfortunately for him, that didn't happen. But it actually might explain why he took that $19 million deal. If you take out 2004, though, his compensation in all those previous years, while high, isn't that far off of other companies of the same size outside of insurance. Martin J. Sullivan replaced Hank, but surprisingly, he was not a bargain. In 2005, his total compensation was in the $13.7 million range. He had been a high-up executive in AIG already before he was promoted, but this represents basically a doubling of Sullivan's total compensation between 2004 and 2005. I mean, personally, even when I was being promoted, I never got my salary doubled. In fact, it was usually a whole lot less, and I'm guessing that you all are the same. If I left the company and went somewhere else to move up, I might be looking at a 20 to 25% increase. I had one boss tell me that for a major promotion, I should be grateful for 10%, and frankly, I should just do it anyway because I would be a team player. Anyway, Sullivan left in 2008, but before he left, he got an amazing payday, a total of $29 million in compensation as the economy was melting down around him and the government was bailing out AIG through TARP. And I personally find that infuriating. A big deal is often made about his replacement, Edward Liddy, who famously took just $1 in salary, though he also made several $100,000 more in what was called other compensation. Still, that was a hell of a bargain. Robert Benmosh took over in 2009, and by 2011, he was making almost $14 million at AIG. Just to put that into context, in 2007, AIG's revenue was $110 billion, and the CEO at the time was paid $14 million. In 2011, AIG's revenue was $64 billion, and the CEO was making approximately the same amount of money for half the revenue. Benmosh left in 2014 and was replaced by Peter Hancock, who made just slightly less, about $12 million. But when Hancock left in 2017, well, he received a big jump with his exit, a total of $24 million in compensation, of which almost $10 million fell under that other compensation category. AIG made $49 billion in 2017, so their revenue fell under his leadership, but it didn't seem to hurt him at all. Brian Duperreault was next. He really upped the salary game here. In 2017, he made $43 million. This was due to a $12 million bonus and $16 million in stock option awards, but even still, this was far and above what anyone else had ever made. Revenue under his leadership continued to fall. The next few years, he made between $18 and $20 million each year. Was anyone at AIG other than him and the rest of the high-level executive team getting good salary increases and bonuses? You tell me. Peter Zaffino took over the CEO spot in 2021, and again, a fairly sizable jump, as he started out at $21 million in compensation on a revenue of $51 billion. Then he had an amazing year the next year in 2022. He received $75.3 million in compensation. $62 million of that was in stock awards. The increase in revenue between 2021 and 2022 was only about $3 billion. Since then, his salary has remained in the $24.6 million range, although AIG revenue has sharply decreased since 2022. In 2024, revenue was only $27 billion. That's just a good example of kind of how this goes. It's all over the place. It keeps getting higher. It doesn't always correspond to revenue. I have questions. And I can certainly get into more detail with this, specific to AIG or any other company. And I'd love to come back to it. Just let me know what information specifically interests you. So looking at AIG, I think you can see a few things. First, executive compensation at AIG has gone up over time, with the exception of that 2008 dip. And second, there appears to be very little correlation between executive salary and revenue growth after 2008. Third, it does not reflect a similar increase in salaries among AIG employees unless I am not talking to the right people at AIG. Much of the growth in salary for executives is stock option-related rewards, which, of course, are often tied to target numbers like share price or revenue goals. As I look at the SEC info, to me, it appears these stock numbers are the actual stock numbers that were received by those CEOs, not just the promised numbers. But if anybody knows different and understands this better, I would love to hear it and figure out what they actually got, if indeed it was different. This is just one example of what I've been digging into, and it is making me so much more curious, not less. You may suspect that I believe that no one is worth this much money, and I will confirm for you, I do believe that no one is worth this much money. I cannot think of anything that justifies these salaries, and I especially can't think of anything that justifies these types of salaries when the people who actually do the work of keeping the company running, the underwriters, the actuaries, the claims professionals, the sales, the support staff, that they're often told they're lucky to get 2 to 3% salary increases each year if that happens at all. What happened to being a team player? So that's where I am right now. At the beginning of this episode, I mentioned that I might need your help. And so here it is. I can't do this project alone. What do you want to know? How far back historically do you want to go? And do you want to help? Let me know either on my LinkedIn or a direct email, and I'll try to include as many people and as many details as I can. Eventually, my goal is to make all this information publicly available and searchable. Let me know your thoughts. And also, I want to remind you to reach out for the Festivus episode. Tell me your grievances about insurance. You can request to be anonymous or share whatever info about yourself that you'd like. And if I pick your grievance to share, I will mention you in the show if you want me to. Thanks for listening. Show notes and selected sources can be found in your podcast player, but you can also visit my new website, insurancevshistory.com, for details. Other than that, I suggest you rate and review, subscribe, connect with me on LinkedIn, or send me an email. Again, you can hire me to come talk to your group about insurance and why it matters, or about a topic of your choice. And you can also contribute to production costs at Buy Me a Coffee. The next episode begins a series on insurance and American slavery. I guarantee you have not heard these stories, and they are important for all of us to understand where the industry has been, even if it's uncomfortable. And there are actually some good insurance stories in there too, I promise. It's not all bad. In the meantime, as I always say, be safe, be smart, and read your policy wording.